Remember 2008? The year that shook the financial world to its core? The air crackled with fear. Banks teetered on the edge of collapse. Markets crashed, sending shockwaves across the globe. Everyone knew the system was broken. Trust in financial institutions evaporated overnight. Today feels different, eerily calm. The streets are quiet, the markets seem stable. But beneath the surface, a storm brews. Unseen but felt by those who look closely. A financial crisis, potentially bigger than the last, gathers force. The signs are there, if you know where to look. This time, the warning signs are quieter, more insidious. No Lehman Brothers collapse, no frantic bailouts, yet. The calm before the storm is deceptive. But the parallels are impossible to ignore. The same patterns, the same mistakes. Once again, reckless lending practices. Loans given without proper checks, driven by greed. Once again, opaque financial instruments, complex, misunderstood, and dangerous. And once again, a system ill-equipped to handle the fallout. The cracks are showing, but few are paying attention. This time, the epicenter isn't subprime mortgages, it's commercial real estate. Towers stand half-empty, retail spaces gather dust, the landscape is changing. The pandemic accelerated a trend already in motion, the death of the office, the decline of malls, a shift in how we live and work. And as property values plummet, a wave of defaults looms. The financial implications are vast. This isn't just about empty buildings. It's about the ripple effects throughout the economy. It's about the trillions of dollars in loans backing them. Loans packaged, sliced, and diced into complex financial instruments. The same dangerous game. Just like in 2008, these toxic assets are scattered throughout the financial system. Ticking time bombs waiting to explode. The calm before the storm is deceptive, and the storm is coming. The office towers, once symbols of prosperity, now loom like ghosts. Remote work, once a novelty, is now the norm. Companies are shrinking their footprints, shedding expensive leases. The demand for office space has plummeted, leaving landlords staring at a bleak future. But it's not just offices. Shopping malls, once bustling centers of commerce, are now ghost towns. Online shopping, already on the rise, has become a lifeline for consumers. The pandemic simply accelerated this shift, leaving retailers struggling to survive. This decline in demand has sent shockwaves through the commercial real estate market. Property values are plummeting, loans are going unpaid, and the institutions that hold these loans, from banks to pension funds, are facing staggering losses. The crisis is most acute in major cities, where the pandemic's impact on work and life has been most profound. But it's spreading, reaching even smaller towns and suburban areas. No corner of the commercial real estate market is immune. While the commercial real estate market crumbles, another threat lurks in the shadow banks. These unregulated entities operating outside the traditional banking system have become major players in the lending market. Fueled by cheap money and a thirst for yield, shadow banks have poured trillions of dollars into risky loans, including those backed by commercial real estate. They've offered easy credit, lax underwriting standards, and complex financial products that even seasoned investors struggle to understand. These shadow banks are subject to little oversight or regulation. They operate with minimal capital requirements and are not backed by the same safety nets as traditional banks. This makes them highly vulnerable to losses, and their collapse could trigger a cascade of failures throughout the financial system. The problem is compounded by the lack of transparency in the shadow banking system. It's difficult to assess the true extent of their exposure to the commercial real estate market and the potential risks they pose. This opacity only amplifies the fear and uncertainty gripping the market. While shadow banks may be the first to fall, traditional banks are far from immune. The financial landscape is shifting rapidly, and traditional banks are finding themselves on precarious ground. They too have significant exposure to the commercial real estate market, both directly through loans and indirectly through investments in mortgage-backed securities. This exposure is a double-edged sword as it ties their fortunes to the volatile real estate sector. The banks are already grappling with a surge in loan defaults, not just in commercial real estate but also in other sectors hit hard by the pandemic and the economic slowdown. This has created a ripple effect impacting their overall financial health. They're also facing shrinking margins as interest rates rise and the demand for loans wanes. Higher interest rates, while beneficial for some, are squeezing the profitability of banks, making it harder for them to operate efficiently. But the real danger lies in the banks' unrealized losses. These hidden losses are like a ticking time bomb, waiting to explode. The decline in commercial real estate values hasn't been fully reflected on their balance sheets, creating a ticking time bomb. This discrepancy could lead to sudden and severe financial shocks. As these losses materialize, banks will be forced to raise capital, curtail lending, or even face collapse. The need to raise capital could lead to a dilution of existing shareholders' equity, further eroding confidence. The failure of even a single major bank could trigger a domino effect, bringing down other financial institutions and freezing credit markets. This interconnectedness makes the financial system extremely fragile. This would have a devastating impact on the real economy, leading to job losses, business failures, and a prolonged recession. The ripple effects would be felt far and wide, affecting every sector of the economy. The whispers started months ago. Big investors, the ones with the most to lose, began making moves, quietly shifting their assets, diversifying away from traditional markets, seeking refuge in safe havens. Gold, once dismissed as a relic of the past, is gleaming again. Its price, a barometer of fear, is steadily climbing. Cryptocurrencies, despite their volatility, are attracting attention as a decentralized alternative to the traditional financial system. Real estate, ironically, is also in demand, but not the commercial kind. Luxury apartments, sprawling estates, anything tangible, a hedge against a crumbling financial system. It's a tale as old as time itself. When the system falters, the wealthy seek shelter in hard assets. These moves aren't driven by panic, at least not yet. It's about preservation, about safeguarding wealth in the face of increasing uncertainty. The smart money is preparing for the worst, even as the rest of the world remains blissfully unaware. This isn't a question of if, but when. Another financial crisis is inevitable. The warning signs are too numerous, the risks too great, the system too fragile to withstand the coming storm. This crisis, when it hits, will be different from the last. It will be rooted in commercial real estate, fueled by shadow banks, and amplified by the interconnectedness of the global financial system. It will be faster, more complex, and potentially more devastating. Governments and central banks, still scarred by the 2008 crisis, are ill-prepared to respond. Their tools are blunt, their options limited. They can try to inject liquidity, prop up failing institutions, but the underlying problems will remain. The uncomfortable truth is that we are facing a systemic crisis, a crisis of capitalism itself. The relentless pursuit of profit, the deregulation of the financial industry, the growing inequality, these are the seeds of our own destruction. The canary in the coal mine is already gasping for air. The early warning signs of the impending crisis are all around us. We only need to open our eyes to see them. Look at the stock market hitting record highs while the real economy falters. Look at the ballooning national debt, a ticking time bomb of its own. Look at the rising inflation, eroding the purchasing power of ordinary people. These are not isolated incidents. They are interconnected symptoms of a deeper malaise, a sign that the system is out of balance, that the foundations of our economic order are crumbling. The longer we ignore these warning signs, the more severe the consequences will be. We are standing on the precipice of a financial abyss, and the time to act is running out. The question is not whether we can avoid a crisis altogether, but whether we can mitigate its impact, soften the blow, and emerge from the wreckage with a more resilient system. This requires swift and decisive action, not just from governments and central banks, but from all of us. We need to acknowledge the problem, confront the uncomfortable truths, and demand change. Governments need to rein in the excesses of the financial industry, strengthen regulations, and provide a safety net for those most vulnerable. Central banks need to rethink their approach to monetary policy and ensure that their actions benefit the real economy, not just the financial markets, but it's not just up to them. We, as individuals, need to educate ourselves about the risks, diversify our investments, and demand transparency and accountability from our leaders. We need to be prepared, both financially and emotionally, for the turbulent times ahead. The first rule of survival: don't panic. In times of financial uncertainty, keeping a level head is crucial, but don't be complacent either. It's important to stay vigilant and proactive. This is a time for prudence, for safeguarding your financial well-being. Taking small, consistent steps can make a big difference. Here's how. First, diversify your assets. Don't put all your eggs in one basket. Diversification is key to managing risk. Spread your investments across different asset classes: stocks, bonds, real estate, precious metals, even cryptocurrencies. This way, if one market takes a hit, others might still perform well. Second, reduce your debt. High levels of debt can cripple you in a downturn. Pay down credit cards, consolidate loans, and avoid taking on new debt unless absolutely necessary. Third, build an emergency fund. Aim for at least 6 months' worth of living expenses in a readily accessible account. This will provide a cushion if you lose your job or face unexpected expenses. It's your financial safety net. Fourth, consider alternative investments. Explore options outside the traditional market such as gold, silver, or even collectibles. These can act as a hedge against inflation and a store of value in times of crisis. Finally, stay informed. Don't rely on mainstream media for financial advice. Seek out independent sources of information, educate yourself about the markets, and stay ahead of the curve. Remember, knowledge is power. The more you understand about the financial system, the better equipped you'll be to navigate the coming storm. Don't wait until it's too late. Take action now to protect yourself and your loved ones. Your future self will thank you for the steps you take today. By following these guidelines, you can build a more resilient financial future.